In this video, we're going to be working to graph the currency exchange markets where we're graphing the supply and the demand for one currency when it's traded for another currency. And what I want you to do first is find this page in your workbook. This is going to be the third page of the International Monetary Exchange workbook pages. So if you could find that in your workbook, then we can get started with this. So I've done a little bit of work ahead of time to highlight some of the differences between these two graphs. So what we're going to have when we're graphing the currency exchange market are two supply and demand graphs that are going to be right next to each other. And in this case, what we're going to be doing is we're going to be showing what happens to the value of the dollar and what happens to the value of the euro when one is traded for the other. So in this first scenario where Johnny's buying a Peugeot, what we're going to do is we're going to end up trading, here we go, Johnny buys a Peugeot. What we're going to do is we're going to end up trading dollars for euro, because what we need to do, if we're going to buy something in Europe, we need to use the European currency. Or if we're going to buy something in South Africa, we're going to use the South African currency. We need to use the local currency. So what happens first is we get that local currency, then we can make these purchases. And the same thing happens with financial assets as well. So what we're going to do is we're going to trade our dollars for euro. And so what I've done here is I have, in this graph on the left, I've got the international market for the dollar. So that's a little bit different than the money market, which we've studied before. This is going to be only in the international market, and you can imagine it's someplace in the middle of the Atlantic or something out in the sky between these two countries or between these two economies. It's not in the United States, and it's not in Europe. It's going to be somewhere in between, if you can envision that. So what I have here is I've got the market for dollars, and I think that part's going to be super important. I've got the market for dollars, I have the quantity of dollars, and then what I have is this part here. I've got a fraction where it's going to be the euro per dollar. So how many euros is it going to take to get a dollar? And that's what we're going to be looking at when we see if the dollar appreciates or depreciates. So what I just wrote on the side, this is going to be the price of the dollar in euros. Is it going to be a lot of euros to get a dollar or very few euros to get a dollar? And the part that's fundamental here, and maybe the trickiest part of this whole lesson, and maybe even this whole unit, is whatever market we're talking about, in this case dollars, that is going to be in the denominator. So if I erase this and get this out of the way, you can see I've got the euro in the numerator and the dollar in the denominator. Whatever market you're talking about, that currency will be in the denominator. Conversely, I've got the opposite over here, where the euro is now in the denominator, because this is going to be the market for the euro on the right. That's the biggest thing that trips people up. So I just want to make sure that you see that. So what I'm going to do here is I'm going to offer up my dollar in order to get a euro. So when I offer up my dollar in the international market, there's a greater supply. I'm like putting my dollars into the market. So the supply of the dollar is going to increase. So what I'll have here is just the supply increasing from S to S1, and you'll see the quantity was here and the price. And what I'm going to do is I'm going to call this the price of the dollar in euros. So you can just write an E. Here now I have the quantity increasing, and I have, most importantly, the price of the dollar in terms of euro decreasing. So now it would take fewer euros to get a dollar. On the other hand, I want euro, and I've happily given up my dollars in order to get euro, so the demand for the euro is going to increase. So I've got the quantity here, and then this would be the price of the euro in dollars. I've got that there, and now it is more expensive to get a euro. The price of the euro in terms of dollars has increased from $sign to $1, and the quantity has increased. Now this is a huge note here. You will not be asked, and you shouldn't really spend too much time worrying about this. The quantities here are not going to matter. What we're really going to be focused on is the prices. Did the dollar appreciate where it gains value and it's more expensive, or did it depreciate where it loses value and it's less expensive? What happens to the quantities, and if they increase or decrease, that will not be asked, and it will not be a big focus of this class or on any of the tests that you might see. So just to quickly look through this, Johnny gives up dollars to get euros. So if I fill this in, the demand for the euro has increased, and the supply of the dollar in the international market has increased. So what I see here is the market for dollars, the supply went up, which we just did. I'm going to fill these questions in. The supply went up. the quantity went up, and again, that doesn't matter. And the price, I'm going to do this, the price in euros went down. So the supply went up and the price went down, which I see right here. In the market for euros, the demand for the euro went up, quantity went up, and again, that doesn't matter nearly as much. The price, but I'm going to do this in dollars, goes up. So the dollar has depreciated. The dollar has lost value because its price fell. And again, I'm over here. That is depreciated. And the euro has appreciated, has gained value, is now more expensive. And I'll make one final note here just to make sure this is clear. In this case, with the dollar depreciating, it takes fewer euro to get $1. And that's how you can tell this is depreciated. It takes fewer euro to get $1. And you again see that right over here where you went from E down to E1. And what we can do in this second scenario is the exact opposite. So in this case, someone named Francois buys a football. And let's assume that Francois is from France and is holding euros now and is going to trade them in for dollars, because we are going to buy footballs in the United States. So what he needs to do is he needs to get rid of his euro and trade it for dollars. So in this case, and I'm going to work backwards here because we're talking about euros first, I'm going to have the supply of the euro increase from S to S1, and I'll put my lines in here. This is going to be the quantity of euro. This is going to be the price of the euro in terms of dollars. And now that price is falling. The quantity has increased, and again, that does not matter nearly as much. So the euro is going to depreciate in this case because the price of the euro has fallen. The reason why it falls is because Francois has a greater demand for the dollar. So the demand for the dollar is going to increase because there's foreigners that are interested in buying our American goods. So here's the quantity and the price in terms of euro, and then the new quantity and the new price, Q1 and E1. So it's going to take more euros to get $1. So the price of the dollars in euro has increased. I'm going to draw an arrow up. And just to recap a couple things here, the supply of the euro has increased and the demand for the dollar has increased. So what I have is I have the dollar appreciating and the euro depreciating. I'm going to fill in these questions down below. The demand is going to increase in the market for dollars, quantity is going to increase, and the price in euros goes up. So we know that this will be appreciating. Conversely, supply goes up, quantity goes up, and the price in terms of dollars goes down. So in this case, when foreigners are buying American goods, the dollar will appreciate. It has appreciated and the euro has depreciated. So what's going to happen when the dollar appreciates? Here, I'll do this. When the dollar appreciates, it's going to take more euro to get $1. So let's say at first it took €1 to get $1. Now it takes 1.5 euros to get $1. So that's how the dollar appreciates relative to the euro, or when compared to the euro. So when you have these currency exchange markets, one of them will get stronger, one will appreciate compared to the other, which will then depreciate. So this is going to take more euro to get $1. And this is, of course, with a flexible exchange rate market. If things are fixed, if one currency is pegged at another, If one goes up, the other will go up. And so this is only with a floating exchange rate uh, system or with a flexible. Those are the two words you might see, floating or flexible, where one can go up and the other can go down. If things are fixed or pegged, if one goes up, the other one is set on that first one. So if one goes up, the other will go up as well. You rarely see questions on that. You're most often going to see questions where one will appreciate relative to the other, and then that other one will depreciate.